So we've had about 90 odd increases in the debt ceiling in the past. And the general consensus view is sooner or later they're going to reach an agreement and increase it this time. Having said that, this time is starting to look a little bit different to me.
April 3rd, 2023, Monaco 64, home of alternative economics and contrarian views. Today, I have the pleasure of speaking with Clive Thompson again. Just to let you know, I've set up a playlist, Clive Thompson interviews, so this is going to be in there too. So far we've got 7 in there, and so this is going to be the 8th. Clive, thank you for coming on. How are you?
Hi, Mario. Good morning to you. Just a reminder for all the Brits who are thinking of going on holidays in the summer, it takes a hell of a long time to get your passport, and now they've gone on strike for another 5 weeks. So,
yeah, I heard about that. Yeah, that's not good.
And you have to remember that now Britain is not in the EU. Your passport needs to have 6 months after the expiry date before you enter the EU.
Well, that's not good news. Good thing I have an Italian passport. Anyway, before we get into the topic of what's going on with the debt ceiling, what's going on with commercial real estate property, just wanted to tell the viewers, yes, it's Monday morning. Yesterday, we saw OPEC Plus, which includes Russia, announce a big cut in oil production of, I think, about 1.6 million barrels a day. I've seen the markets overnight. They haven't reacted that much to it, except oil, of course, has gone up about 5-7% at one point. Gold and silver, you would expect them to go up, but I think the Exchange Stabilization Fund is busy in there trying to keep it down, but that's a different subject. So just wanted to say that we're not going to do the market report. We're going to go straight into commercial real estate property. And Clive, you wrote recently on LinkedIn that you think it could be the next shoe to drop. And the real interest rates, of course, are very important.
So exactly, this is what I'm thinking about. Commercial real estate is suffering from a problem related to the interest rates. So what we're seeing, if we look over here, and I'm showing you here the US prime rate, and you can see, if you can't, I don't know if you can see this, but it was 3.25% for much of the last decade, and certainly for the last few years. So as they raise the rates, the cost to people who are buying property now in interest terms is a lot. And I just did this little chart here, which you can see. I'm taking a typical property in America, commercial office block, large office block, which would have been worth back in 2015, 100 million. And what happens if we raise the interest rates? You look in here at the 1st of July, 2025, we're assuming it's 10 years. And the rate of interest, I'm assuming, has gone up by 2%. Now, just to put that in perspective, interest rates at the moment are 4% and a bit higher than they were back in 2015 and in 2020. But I've just assumed an extra 2.25% interest, and that reduces the value of the property on the same rent to 64 million from 100 million. That's a 36% reduction. But what if the tenants don't need so much space and the lease comes to maturity and they reduce their space by 25% from, so instead of paying 4 million in rent, they pay 3 million, because now instead of occupying 4 floors, they're occupying 3 floors. The reason they need less space is 2 things: hot desking and work at home. And you see from this that with the rent going down to 3 million, the property value drops to, on a like-for-like basis, 48 million, down 52%. So I think as far as banks are concerned, the next shoe to drop could well be the value of their commercial real estate loans, because what's going to happen, some of these owners of properties are literally going to be in negative territory when their lease matures and they're having less rent coming in, and they have to renew their fixed term loan and they're paying more interest. And some will be just simply handing back the keys to the bank. And so I've seen a number of lists produced both for the United States and for Europe as to which banks are most exposed to this area. You could look on my LinkedIn posting that both lists are produced by Bloomberg. I'm not going to say the names of the banks because I don't want to be the cause of any sort of panic. But let's just say in Europe, the most exposed banks are the Scandinavian ones, and it lists them by name. And anyone who wants to go look them up can go and have a look up. And if you look in the United States, you'll find some names as well. They're mostly small regional banks, but I'm sure there's going to be some very large banks in there. So that would be my comment on the next shoe to drop in the banking crisis. Will it turn into a panic or not? We'll wait and see. Janet Yellen doesn't think there's going to be any more panics. She thinks that we've done everything necessary, but we'll see.
Yeah, Janet Yellen also was the one who said doing QT was going to be like watching paint dry. And she said, I think just before she became Secretary of the Treasury, that there wouldn't be another financial crisis in her lifetime. But another question I have, could you tell the viewers what the prime rate is? Because we usually look at the Fed funds rate.
Yeah, so the prime rate, as you see on this chart here, is the lowest rate at which top quality borrowers can borrow from a US bank. So at the moment, the prime rate is 8%. And before so if we're looking at this chart here where my mouse is on the right-hand side, that's 8%. And before it all started, it was 3.25%. Yeah, I think 3.25. Is that 3.25? Yeah. Yeah, that's 3.25. So the prime rate has risen by 4.75%. That's a reflection of how much it's going to cost people for their mortgage.
You used a rate of 5.25, which is actually very conservative for that 10-year period. What's the 10-year period again? Is that when the mortgage, the financing deal, like expires for the landlord?
So typically when you borrow money for a commercial real estate, you try and fix your interest rate for a fairly long time. So if you've got a 10-year lease, you might do 2 5-year fixed interest terms. You might get a 10-year term, but of course that will would have cost a little bit more. So probably people would have gone for a period like 5 years and then rolled over after 5 years. So in the example I showed here, I'll just go back to this, and I'm assuming that the borrower of the money is a prime borrower. Let's just go back here to where we are. If you look where my mouse is, he would have perhaps taken out the loan somewhere here about 2015 for 5 years. 5 years, rolled it over somewhere in 2020 perhaps, and now we're going to have a loan maturing in 2025. But the numbers could have been 2024, 2023. It doesn't matter when it's going to loan. Some will mature a little bit later. But as these loans mature, the interest rate is going to be now higher. If it was maturing today, it'd be a lot higher. If it was maturing in a year's time, I've assumed that interest rates, and I've been very generous to the Federal Reserve here, assuming that, or to the banks rather, I'm assuming that we'll have 10 cuts in the interest rate of 0.25%, bringing it down from 8% to 5.25% in my example of how much it costs to borrow money. I'll just go back to that example here. So there you see the example. I've assumed a rate of 5.5% instead of the current 8% that you might be borrowing at to arrive at the value of 48 million. So to go from 100 million to 48 million, I'm assuming two things. One, that the rent drops by 25%. I think that's a reasonable assumption with the hot desking and work at home. Tenants won't need so much. And two, I'm assuming that the interest rate is 2.25% higher from what they were previously paying. Previously, they're paying the lowest rate of 3.25%. Now I'm assuming 5.5%, but not the 8%, which is where the interest rates are currently sitting. So you can see it's pretty dire for commercial real estate, or at least for office blocks. Now, this doesn't apply to all commercial real estate because not everything is offices, but offices are the ones which are definitely most affected by the new way of working. And it's not just working at home, it's the new style of working, the paperless office. Hot desking is what I would call it, where 3 or 4 people can effectively use the same desk on different days.
I see. Okay, so that we'll move on to the debt ceiling. Just before we do, yeah, I just wanted to tell the viewers this is very much like the crisis we've had with the banks going under in the US, SVB. But with them was a portfolio of treasuries, which is, I guess, a loan to the government. This is with a portfolio of commercial real estate loans, which is kind of like a bond as well. And it just shows how interest rates affect the value of that security or that asset. And you kind of wonder whether the Fed will start buying commercial real estate paper at par if things get pretty bad. But with that, Clive, let's move on to the debt ceiling, because you think it could be different. And I know people always say that this time it's going to be different or not. But yeah, and we haven't been seeing much about the debt ceiling. There's a lot of other distractions out there, of course, with Trump, with Russia, with China, with the BRICS. So let's get on to the debt ceiling then.
So we've had about 90 odd increases of the debt ceiling in the past. And the general consensus view is sooner or later they're going to reach an agreement and increase it this time. Having said that, this time is starting to look a little bit different to me. I'm seeing a lot of politicians who are now saying they've reached an impasse and neither side will give way, and they see little hope of going forward.
And at the moment, I don't see how we get there. And this is a market change from where I've been.
You don't see how you get where?
To a debt ceiling agreement. I don't even see a path. There's an expectation a discharge petition would work. There's no mechanism for that to work in the House. There aren't votes sufficient to have a clean debt ceiling increase. It's clear the Senate, they have operational choices there. And if they wanted to, if they thought they could pass a clean debt ceiling increase, they would have already done it. And they haven't. So we're at a standstill.
Of course, if the US government cannot raise the debt ceiling, it means that by about June or July, they'll reach a point where they can't pay the interest on the national debt. And that would be catastrophic for the United States. It would be catastrophic for the world. It would involve a large reduction, several percentage points reduction in GDP.
The failure to raise the debt ceiling would cause an economic and financial catastrophe. It would be a failure of the U.S. government for the first time since 1789 to fail to pay bills that it had incurred. And it would cause a loss of confidence in the United States.
And it would destroy to some extent, reduce the value of the dollar globally. So that's something which everybody's fearing, but in the United States, and you could Google it, but you'll find many politicians in the United States now saying, we don't know where it goes from here. Neither side will give way. It's the other side's problem. And what they're fighting about is the problem of the budget. So it's not a question of balancing the budget. It's to what extent it's a deficit. But let's just have a look at how serious it is in terms of probability of default. This is a list of the probability of default of various countries. And on the line, which is marked United States, you see it's calculated, the letter PD means probability of default. It's currently calculated at 0.45%. That's 0.5%. Probability a 1 in 200 chance. It's not a high probability at this point, but the number might increase. And if we just look at the direction of travel, you see the direction of travel of the probability of default. It is rising. So here we have just a comment I picked up somewhere. The United States 5-year credit default swap is 27.79. This reveals a 0.45 implied probability of default on a 40% recovery rate. Now, we all still expect something to be solved, and that was on the 5-year bond. And if you can see the chart here on the 1-year bond, this goes back to February 2022. You can see how the probability of default has rocketed upwards recently. And a comment I just found on the government's own website. This is from either the Federal Reserve or the Treasury's website. It says, their own words, since the United States has never defaulted on its obligations, the scope of the negative repercussions related to a default are unknown, but it would likely have catastrophic repercussions in the United States and across the globe.
Well,
The United Kingdom.
Sorry, just a comment. The United States has defaulted on its obligations before, back in 1971. So, but anyway, and it's not
It's
not surprising though that we're seeing a lot of the BRICS countries move away from the dollar. Maybe they can see the writing on the wall. But you wanted to show us the UK CDS, which is interesting. The UK, of course, doesn't have the major reserve currency.
So here we see on this chart the probability of default in the UK is rising. But you can see what happened last September when we had the crisis in the bond market. It's come down, and now it's starting to rise again. So just bear in mind and keep an eye on it. The probability of default in the United Kingdom, as you see down here, is calculated at 0.33%. In other words, very unlikely, but still not an impossibility. Now, let's just have a look at the United States national debt over time. It currently stands at $30 trillion and has been rising fairly rapidly in the last year or two. And the reason it's rising is because year after year, USA is spending more money than it gets in taxes. That's called a deficit. There's the deficit as of last night. It's this is the deficit for the current year, not the total deficit since the beginning of time. The current year, they've run up $722 billion of expenses more than they've collected in taxes. And that's not new. Looking at this deficit over time, you can see the black line here on the right-hand side is the current year. We're only halfway through the current year. The red lines are the full years. So you can see that in 2021 and 2022, the deficits reached all-time records. And what's the USA projecting for the future? Well, here this line here is where we are today. They're projecting increased deficits going forwards. And if we so this is a little chart showing the deficit as a percentage of GDP, and you can see that as a percentage of GDP, the deficit, or not the deficit, the debt of the government is rising. That means each citizen who's a taxpayer, as his share of the debt is going up. No matter even though he's earning more, the debt is going up faster than he can earn, faster than GDP is rising. So how bad is it? Well, under the president's budget, which is at the moment the reduction which is being argued, this is based on the reduced budget because the other side are arguing for more. The public debt will rise from 24 trillion to 46 trillion by 2033. And that's the official budget from the government's budget office, showing, if we look over here on the right-hand side, billions of dollars, we can see it going to 46 trillion from 24 trillion. That's 2022, 24 trillion debt, up to 46 trillion. So it's nearly a doubling of the debt within 10 years. A massive increase.
Yeah, it's just like mathematically, it gets exponential, and it's like a parabola. And the other thing I would say, if you look at the debt to GDP, which is around 124%, that's based on nominal GDP. If you look at real GDP and you put the national debt divided into it, it's more like even 150%. And the public debt held by the public, that's less than the 31 trillion that we have right now. It's just that they don't put down what the Fed owns and some other government entities, right?
That's right. I just putting up a little chart from the government's own website showing the current projected level of debt to GDP. As you can see, where it says projected, where this line is here, And the projection is for the level of debt to GDP to rise exponentially. Not only are we passing the highest level ever, but we're going to, in a few years, to over 200%. This is from the government's website, their own words, not my words. Under current law, we project that national debt will rise to 225% of GDP by 2050 and continue to rise thereafter. So that's basically where the government's going. It's going to an all-time record level of GDP, a level which has never been seen before, and we don't know who's going to pay, who's going to take all that debt, because as the debt rises, and we're talking about a massive rise in the national debt, someone has to buy it. So who's going to buy it? Is it the public? I don't think they're going to buy it at these interest rates when the interest rates are below the rate of inflation. So will it be the Federal Reserve? Will the Federal Reserve or the government or the Treasury force the banks to buy it? But obviously we know what happened when the banks bought treasuries recently. So it's very difficult to say who's going to be the taker of all this new debt which needs to be created to deal with the now proposed reduced budget from the president, which has not yet been approved, and that's what's being fought over, because there's many who want even more spending than is proposed by the president.
Yeah, I saw the other day, there's a clip, someone asking Yellen about the deficit that the proposed, or the budget, the proposed budget was 4.7 trillion. And she said, yeah, it's something like that. But one thing I would say is that if I was running, and I probably wouldn't want to run like a treasury or a ministry of finance at another country, and I see this, what's happening to the U.S. finances, and I'm holding hundreds of billions of dollars in reserves, I would be concerned. And I'm not saying other countries have very good finances, but it's not as bad as the U.S. And the U.S. has been able to do this because you've had 40 years up until 2021 of decreasing interest rates. But it seems to me now that the tide is turning and we're going to see higher rates. So it's a cocktail for disaster, I would say. And yeah, it's pretty scary, in my opinion, not just for America, but for the whole world. And I think that's maybe why the BRICS countries, a lot of countries like China and Russia, are trying to move away from the dollar, not because they want to maybe compete with the US, but because they want to look after, they're seeing this and they're saying, wow, this thing is going to become worthless. What's your opinion on that?
Well, Janet Yellen was asked about the problem before the Senate the other day, and she said that she doesn't think the massive increase in the debt level is a particular problem, because according to the Treasury's projections, the real rate of interest, and I think that word real went unnoticed, people just heard the word interest rates, but the real rate of interest, she said, is very low. And actually, that is the truth. The real rate of interest is currently negative. So it is very low. And in her opinion, as long as they have a low real rate of interest, increase the level of debt is not a problem. But I don't see real interest rates staying this low for long, because I think it's, whilst the government probably could control the short end and eventually they could control the long end by buying lots of bonds, it's only a question of time before something breaks. So I do think we will at some point see a very steep yield curve. Right now, the yield curve is negative. That means that the shorter date bonds have a higher interest rate than the longer date bonds. That's abnormal. Normally, the longer date bonds have a higher interest rate than shorter date bonds. But when we get back to normality, I think that over time, that curve could steepen a lot, because you can't get people to buy these treasury bonds, which are needed to fund the deficits, unless you pay them more. And does it make the dollar worthless? Well, I think things can go spiral out of control very quickly. I don't want to scaremonger or say that the dollar is going to nothing quickly, but I think we're in that direction. Certainly, the dollar has lost 97% of its buying power in about 40 or 50 years, and I think that will go a little bit faster in the future through inflation if we don't have a crisis which brings it down faster.
Yeah, and it seems to me what Yellen said there that you noted about the real interest rate, she said it's very low. It's actually negative. She seems to think that they can fool people into investors into losing 2 or 3% every year, and that's how they'll write off the debt. And like you said, not just domestic investors, foreign investors, they're going to wake up to that. And I think they're waking up to that already. So before we conclude, Clive, just what do you think as being a wealth manager in your career, retired wealth manager, albeit, but what would you be doing right now with your savings if you know this is happening, not just for Americans, but for everyone around the world?
Well, first and foremost, everybody should keep some cash because they don't know if they're going to wake up tomorrow and find the banks are closed. So they need some cash at home. And secondly, they need to keep some cash in the bank to cover their expenses for a few months. So my message is, first of all, don't go and, after what I'm going to tell you now, don't go and stick everything into gold or silver or property or equities or Bitcoin or whatever you happen to choose. But what I think you need to do is look at how much cash you should keep for emergencies, medical emergencies, if you lose your job. Then take the excess, and that would include anything you have in bonds or nominal assets, and put it into more tangible things. Now, clearly, gold and silver are tangible things, and I think the environment is right for a rise in the gold price right now. But I would also say equities. Companies are very good at navigating the woes of the world, and they do own a lot of assets, which hopefully will navigate a higher, the assets will be protected by higher inflation, and the boards of directors are pretty smart cookies, so they should be able to navigate the woes of the world. Real estate is great, provided you can buy it at the right price. Now, we've always touched on commercial real estate, and that already is, I saw a program yesterday saying that it's already falling a lot in some places. It's probably got further to go. But, those who can afford real estate, you want to look at buying it at the right price. That means a lot lower than it was. And if you could expand your own home or do a loft conversion or buy some things you need, I would use up your money. Do not leave too much money in fiat is my message, and be diversified.
Great. Thank you very much, Clive. It's always great to speak with you, and I wish you a great day.
Thank you very much, Mario, and have a nice day. Bye-bye now.
Bye.